Welcome to Module 1. In this module, our focus will be exclusively on learning all the different aspects of a mortgage. Before getting into the technical aspects of mortgages, let's initially explore the options available for obtaining a mortgage. In Canada, you have two primary ways to arrange a mortgage: through the bank branch or through a mortgage agent or broker. At the branch, you're limited to that bank's products and rates offered by their sales rep. With a mortgage agent, you access products from multiple lenders, offering you more options. Some other key points about mortgage agents and brokers are: we are free to use in nearly all cases, except when arranging lending with a non-prime lender. We have access to over 30 lenders, including major banks, credit unions, and mortgage companies. We act on your behalf, prioritizing your best interests. Our unparalleled product knowledge empowers you to make informed choices, ensuring you select the best rate type and product aligned with your goals and needs. Our access to multiple lenders ensures you are getting the most competitive rates. This flexibility sets us apart from branches which only have access to their own rates. We stay informed through regular meetings on economic trends and policy changes, which we then use to assist Our in lenders choosing can be the categorized appropriate into rate type major banks, and credit term unions, based on mortgage current companies, economic conditions, alternative lenders, and private lenders. We assist you in selecting the lender based on your personal preferences, whether it's rates, available products, income type, credit profile, or unique mortgage requirements. Our role is to thoroughly understand your financial goals, upcoming life events, and economic conditions, guiding you to make the most suitable decision. Now let's talk about the two main mortgage rate types: fixed and variable rate. With a fixed rate, your interest rate stays constant throughout the term of your loan, keeping monthly payments predictable and making it easier to budget. Then we have a variable rate, which is a floating rate. A variable rate doesn't have a fixed interest rate. Instead, they have a rate that is tied to the Bank of Canada rate decisions. The Bank of Canada schedules 8 rate announcements yearly, impacting floating rates. In a slow economy, rates may drop to encourage lending. However, in times of high inflation, rates might rise to curb spending and bring inflation down. For variable rate mortgages, your mortgage payment is either static or adjustable. If static, the amount applied to principal and interest is adjusted, not the payment. Meanwhile, with an adjustable rate mortgage, mortgage payments fluctuate with changes to prime rate, keeping you on your amortization schedule. When choosing a rate, it boils down to a few key factors: economic conditions, financial goals, property use, and risk tolerance. Do you prefer stability in your payments? Opt for a fixed rate, especially if you can't afford payment fluctuations. Thinking of making changes during your term? Consider a variable rate with its flexibility, or a shorter-term fixed-rate economic conditions play a crucial role. It's essential to work with someone knowledgeable about our economy's impact on rates. Ultimately, your choice depends on stability, future plans, property use, and current market dynamics. Once we determine your rate type, we strategically choose your mortgage term. The mortgage term refers to your contract length and the duration for which a specific rate is locked in. Many people focus on rates as the primary way to save money on a mortgage. However, the most significant savings come from selecting the right term and amortization for your mortgage. Most lenders offer terms ranging from 6 months to 10 years. But how do you decide? Another factor in choosing your rate type and term is the stress test you need to take to qualify for your rate. This financial assessment is implemented by financial institutions. It assesses a borrower's ability to manage their mortgage payments if interest rates were to increase. Borrowers are stress tested against either the higher of minimum qualifying rate of 5.25% or their contract rate plus 2%. This ensures that borrowers can manage their payments if interest rates rise in the future. Once we establish your rate type and term, the next step is determining your amortization, which refers to the time to pay off your mortgage. If you are putting less than 20% down payment, you're required to qualify on a 25-year amortization, which gives you insurable pricing, the lowest rates in our pricing tier. The government has recently announced that first-time home buyers can now get a 30-year mortgage as opposed to 25-year amortization when they put less than 20% down payment towards their home purchase. This allows them to qualify for more mortgage. If you have more than a 20% down payment, you can go as high as a 30-year term. This option offers better month-to-month cash flow. You can use prepayment privileges to pay down your mortgage faster while benefiting from lower monthly payments. Keep in mind that you have to qualify for your amortization. The shorter the length of time, the higher the mortgage payment, which potentially means you qualify for a lesser amount. Lastly, the two terms you will need to know about your mortgage are prepayment privilege and prepayment penalties. Prepayment privileges refer to the amount you can pay on your mortgage before facing a penalty. Generally, you have two options: lump sum payments, which allow you to put down 10 to 20% of your remaining balance per calendar year. Secondly, an increase to your mortgage payment. This enables you to boost your mortgage payment by 10 to 20%. The benefits of utilizing prepayment privileges include faster mortgage payoff. Using prepayment privileges allows you to pay off your mortgage more quickly. Even small additional payments can significantly reduce the total time needed to pay off the loan. Interest savings. Paying more towards your mortgage means less interest paid over the life of the loan. As interest is calculated on the remaining balance, reducing the principal amount decreases the overall interest accrued. And finally, prepayment penalties. Prepayment penalties occur when any payment beyond the allowed amount triggers a penalty, typically when breaking your mortgage before its maturity date. For variable and adjustable rates, penalties typically involve a 3-month interest penalty, varying between lenders depending on how they calculate this against your contract rate or prime rates. With fixed rates, the penalty is the greater of either a 3-month interest penalty or the IRD, interest rate differential. The IRD calculation involves comparing the discounted rate and posted rates, calculating the difference in interest fees left to pay based on both rates. The key to avoiding high penalties lies in planning and choosing the right mortgage rate type, term, and product. As you can see, mortgages involve much more than just interest rates. Understanding your individual goals, income type, and risk tolerance is crucial in building the right mortgage for yourself. We'll guide you through all available options and assist in choosing based on your unique needs.